Good morning, everybody. This is Bob Parker. Just to say welcome to the Asset Management and Investors Council event today to talk about coronavirus and how the asset management industry is managing the industry through this, this unprecedented crisis. First of all, we have Max Castelli, Managing Director at UBS, who is an expert on the sovereign funds and central banks. Joanna Kund, Head of Public Policy at BlackRock, and Christian Kopf, Head of Fixed Income at Union Investment. We really want to try and address sort of three areas in this event. The first area is how the asset management industry has managed itself, how it's navigated the industry during the last 3 to 4 months. Secondly, how we have engaged with policymakers and what the policymaker reaction has been to the crisis, and obviously making some comments really on central banks, on fiscal policy and regulatory policy, and how that is impacting markets and our industry. And thirdly, and probably sort of most interestingly, what are our views on what's going to happen over the balance of this year as hopefully we come out of this crisis, and then also some longer term themes. I think are there some lessons to be learned in the asset management industry over the medium and longer term? But let me start off with the first question or first theme of how we have navigated through this crisis, and I would start by actually addressing a question to Christian, and to what extent it has, in using the example of Union Investment, to how have you actually sort of managed the business during what has really been a sort of unprecedented and difficult way of running an asset management business. So Christian, if you could tell us what you've done over the last 3 months or so.
Yeah, thank you very much. It has really been unprecedented for us. So what we've done is early on, we shifted to a modus operandi where around 90% of the staff work from home and 10% of the staff work from the office. And we've kept that until 3-4 weeks ago, when the German government started to ease the lockdown measures that have been imposed in public life. And since then, we've moved to a different modus operandi, whereby roughly a third of the staff is working from the office, another third is working from home, and a third or another 2/3 are working from home. And then we have a rotation system where Group A and Group B rotate between working from the office and working from home in intervals of 2 weeks, in order to avoid any infection between those two groups if they were to occur. Now, I must say that it has worked rather well, surprisingly well. I would say we've had a very smooth move into this new system. We have started to operate very much via video conference, as we're doing today, several video conferences every day. And we have, before the crisis, already started to strengthen the digital forms of interaction within our firm, chat rooms that we have on 24/7, and video conferences with people working remotely. So we've just basically made use of these systems which had already been established and have enlarged them. Yeah, so it was a big challenge for all of us, but it has worked rather well. And I'm quite happy with the results, and we've had very little disruptions, I would say. Now, it is possible that some of the elements that have been tested during this coronavirus lockdown period will remain with us and will become part of our day-to-day life even after the pandemic has ebbed.
You want to just comment? One interesting question, which has been troublesome for everyone, Christian, is the sort of carrying out transactions from home or trading from home. And the whole idea of, the concept of a centralized trading desk in an asset management business obviously has been severely disrupted. How have you managed that?
Yes, so our regulator has approved an internal policy which basically says that whenever you operate from a union investment system, which is connected entirely to Union Investment's software and and backbone via VPN, then you are not working from home. So working from home, according to the German regulator, means working from a non-work system. But when you basically take your system home with you and operate with that system using a VPN channel and using the agreed trading venues that we have and the agreed trading systems, Bloomberg, market access, and so forth, then this is not considered working from home from a regulatory point of view, and it has worked rather well.
That's interesting. Joanna, let's just move on to issues such as fund liquidity, valuing investments, and also, given your work at BlackRock, some comments on how the ETF industry has held up would be useful.
Great, thank you very much. I mean, one of the really interesting aspects of a crisis is you get to see what works well and where some things might need a bit of a rethink. Starting with investment funds, they were dealing with bond markets that had seized up and increased redemptions. The most important thing, though, is that the very vast majority of funds held up fine, even under these stressed conditions. A relatively small number of funds suspended, and this was very largely because of a lack of clear valuations, which was creating investor protection issues. So we saw this with UK retail funds and some funds in Denmark. A far smaller number of funds suspended because swing pricing was not permitted in there, or it's not permitted in a certain jurisdiction, so that asset managers weren't able to ensure that the redeeming clients bore the cost of that liquidity and so protect clients. And in that situation, suspension is the appropriate tool. We saw this happen in Sweden with some bond funds. The key takeaways from my mind on this is that fund suspension is a totally legitimate tail end tool, but the circumstances where it was used in March, April were all outliers. So the UK real estate funds invest in inherently illiquid assets and are open-ended. And this is being addressed by new FCA rules. But in the interim, the FCA, working with trade associations, advise managers to suspend funds given the material valuation uncertainty. The Danish funds are unusual because retail funds, a lot of them are traded on the exchange. They're not ETFs, but they're traded on the exchange, and they have to be valued 3 times a day by the fund administrator. And if the fund administrator feels it can't do that, then they are expected to suspend the funds. And finally, most countries provide for swing pricing. I think Christian can say when it was introduced in Germany. So Sweden, again, in not allowing or permitting swing pricing is an outlier there. I would say that when suspensions occurred, they were short-lived, they were accepted by investors, and it didn't lead to contagion. The second point I want to mention is about swing pricing. You'll have seen a lot of data on outflows, and in aggregate, the absolute amounts were significant. If we look at net outflows across funds, as a percentage of funds, it was much, much lower. So around 1% for equity balanced alt funds, a bit higher at 2.5% for bond funds, but this masks a very wide range of situations. And for some funds, they saw significantly higher outflows. And it's particularly in these cases that you need swing pricing to protect the clients that stay. If you don't have swing pricing, the only alternative you have of protecting clients is to suspend the fund. Also, from a financial stability perspective, swing pricing is seen to remove potential first mover advantage from funds. You also mentioned ETFs, and leading up over the past few years, a number of commentators have said, how would ETFs perform in a crisis? Would the structure break? So this provided a really good test for ETFs and highlighted a couple of aspects that were perhaps underappreciated. First, ET stands for exchange traded, and trading of the ETFs soared in the secondary markets. We've always seen this at periods of stress, but it was far more pronounced in March and April. Essentially, when the bonds that are essentially or generally OTC traded froze because bank balance sheets became constrained, the exchanges don't require capital, and they were functioning as normal and allowing investors an avenue for adding or taking away risk. So ETFs ended up providing an alternative additional layer of liquidity to market participants. We also saw some discounts widen on ETFs, and some people point that out as a flaw, but actually it was demonstrating the value that fixed income ETFs provide in terms of price discovery when the underlying markets aren't pricing securities. So essentially they were leading the pricing with ETFs changing hands hundreds, if not thousands of times a day, and the pricing of the underlying bonds then catching up later. On this, there's been a number of official reports. One is by the Bank of England, and it was stressing that ETF shares, I'm quoting here now, ETF shares compared to the corporate bond market, price discovery was often occurring via ETFs rather than their underlying assets. And it also compared ETFs with mutual funds, musing whether early redeemers in mutual funds might benefit from a first mover advantage. But it concluded that evidence that swing pricing adjustments applied during March were high, and this could have mitigated first mover advantages. So I just come back to that because it reiterates the importance of swing pricing, not just as a investor protection mechanism, but also from a financial stability perspective.
I know there was quite an interesting report which we reviewed at our Asset Management and Investors Council Executive Committee last week from Fitch, where they were trying to evaluate whether redemptions versus valuation issues were more problematic. And their conclusion seemed to be that actually valuing securities or less liquid securities in mutual funds was more of a problem in terms of managing those funds rather than managing redemptions. And they seem to, whether you agree with it or not, they seem to take the view that actually the asset management industry had actually managed redemptions reasonably smoothly. I don't know, do you agree with that?
Yes, I do. If you look at the funds, first of all, the number of funds that closed was very small. And if you look at them, it was virtually always because of valuation issues, not liquidity issues. The exception to that was Sweden, where you don't have swing pricing. So again, they were forced to protect clients to close funds, a small number of funds. In terms of there were higher redemptions. On average, it was low. You saw relatively smaller funds having percentage-wise higher redemptions, and that's precisely where you use swing pricing. So the industry worked as it was meant to work, and investors were protected, and you didn't see sort of issues from the end investor perspective. So I think it all worked well.
And then just sort of moving on, Max, to investor behavior and sort of how you and your team at UBS have been working with clients through this period of high volatility. I just sort of, by way of introduction to this question, just make two observations. In the middle of March, the VIX actually reached 85, which was exactly the same level that it reached in September 2008 when Lehman Brothers went bust. So, the level of volatility was actually very similar in markets to what we saw in late 2008. I think just another observation is that obviously since late March, we've seen a significant rally in credit markets. We've seen a significant rally in global equity markets. And if you look, for example, at the sort of the Nikkei, the Euro stocks, and the S&P, since the 23rd of March, they're all up by about 40%. And John Authers at Bloomberg, who writes a sort of literally every day a sort of review of markets, he calls this the world's most hated rally, because obviously we have this disconnect between what's been happening in markets in April, May, and so far in June, and that is, you have to question whether that's connected with what's happening in the real economy and to corporate earnings. But Max, if you could just sort of comment on how would you describe investor behavior through this crisis, and obviously everybody be very interested in what you have been advising your clients.
Thank you, Bob, and welcome everybody. Let me maybe just very shortly do a little bit of history here. So about what happened since March. So the main feature of the market sell-off in March was probably the speed. I mean, we compare different phases, different bear market over the last few years, and actually the switch from a bull market to a bear market in March has been the fastest on record. It happened everything in a matter of around 2 weeks. So I would say that many investors were probably caught by surprise in particularly by the speed of the correction. So that was something that I think had an impact as well on the reaction of investors. In terms of what they did, maybe let me sum up in 4 bullet points. The first of all, we haven't seen any sort of panic selling, if you want, which is something remarkable. I think it also shows that probably 10 years after the last big sell-off, institutional clients, I'm talking more about institutional clients in this case, simply because these are the one I'm more familiar with, they've been pretty resilient in terms of observing the situation before taking action. The second implication was that the major concern was probably not only about, of course, a falling asset price and impact on portfolio, it was mainly about liquidity. You pointed out very correctly that in the beginning of March, we had some liquidity issues in the fixed income market. These liquidity concerns were very high. And actually, we can discuss it later when we talk about the policy response. Probably this, the intervention of the central banks in particular, providing massive amount of liquidity helped a lot. And according to what I hear from our portfolio manager trading, the liquidity condition have improved since then, pretty dramatically in certain cases. The third reaction has been about rebalancing. As you know, institutional investor, the one who want to stick to their strategic asset allocation, they normally rebalance. I think here, what I heard from clients around the world is that due to the speed of the correction, rebalancing only took place in a certain way, on a partial way, if you want. And I think that this is something important because looking now, following the big recovery in price in April and May, probably many investors, if they had rebalance accordingly to their policy, probably they would find themselves now with a higher equity allocation. So looking ex post, this was the right choice to take. And the fourth point I would like to make is that, of course, in addition to the concern about liquidity and falling asset price, we also see the many investors in taking advantage of some opportunities in the market. We saw some growing interest, for instance, on certain asset classes. China's equity is one example, but also in general, all the investors which were building up equity as a diversification away from fixed income, they took advantage of the dip in the market to enter at a more attractive price. What was the immediate implication of the market sell-off? Was that, of course, the long-term outlook from key risky assets, in particular credits and equity, improved dramatically. This is not something new. Every time you have a sell-off, of course, you have a new level of price. You have the premium on risky assets go up. This is what you would expect from an asset allocation, and that's exactly what happened. Then if investors find themselves to make a choice between buying in the market at the bottom eventually on the expectation of a rise, or eventually stand, let's say, on the side and waiting for things to develop. Now, the recovery in asset price in April and May, in certain extent, you said yourself, I would say has been pretty spectacular. Probably it's been a result of the massive fiscal policy and monetary policy response. And also, I would add the conviction that COVID-19 was a certain type of crisis. Most of the times there was a reference to natural disaster. These crises normally they have two characteristics. They tend to have a very big impact in the short term, but on the economic activity, but they also tend to be a little bit short-lived. And actually that's what the market still believe, despite all the uncertainty that we are observing in terms of the pandemic and of course in terms of the economic activity level. Now, it is what I would like to stress, that it is very important to note that during this sell-off, what happened is that the the so-called balanced portfolio, or if you want a portfolio diversified within fixed income and equity, actually behave exactly how it was supposed to behave, with government bonds providing an important cushion to the losses that one experienced on the equity. Now, I did some estimate. We ran a sample portfolio for, in particular in my client segment, central banks and sovereign wealth funds. And just to give you a magnitude of where do we stand at the end of May, central banks, which are typical heavy fixed income investors, but increasingly diversified as well into equity, most of the portfolio are in positive territory. So they are year to date. And if I look at instead the sovereign wealth funds, which of course have a much more equity and alternative asset classes type of asset allocation, they are down between 5 and 10%, depending on which type of entity we are talking about. So let's put things into context. In the last financial crisis, about 10 years ago, losses on a yearly basis were between 25 and 35% in sovereign wealth funds. So we are well below the market dislocation that we experienced during the financial crisis. So now, what we have been advising to clients? Of course, I mean, the big challenge for any investor, being retail or institutional during a sell-off, is that pushed by panic and fear, they might depart dramatically from their investment policy. That's something that is fundamental. As I said, we haven't seen very much of that. And this is very important because many losses that were experienced in March were actually recouped in the following months. Now, as we stand now, after these 3 months, the question is, what type of environment are we moving in? Now, I think there are 2 main factors that I would like to stress. The first one is that, of course, already before COVID, we were living in a world where we were expecting interest rate to remain low. We used to call it low for longer. I call it low forever, in the sense that it's very difficult to see interest rate going back to a sort of a normal level. Post-COVID, I think we are in a situation where the last bastion of positive yields, the US, in some way converge towards the zero rate level that we are observing for a while across Europe and Japan. So what I think we are going to see going forward is that I call it the search for yield 2.0. We are going to see investors struggling, and we already see investors struggling to generate returns which are required for liability management reason or simply because that's their long-term return target. What type of diversification will eventually be used? And this is, I think we're going to see more equity. I think we are going to see, more importantly, more alternatives. Why more alternatives? Because one of the problems going forward will be that a balanced portfolio it will be very difficult for a balanced portfolio to perform well during the market sell-off as a result of fixed income providing a cushion to the equity and to the risky asset. So investors at the moment are wondering themselves, how can I diversify my portfolio, introducing an element of diversification different from equity, eventually with lower volatility. And I think we are going to see a growing interest in asset classes like real estate, private equity, and as well infrastructure. Final remark I would like to make, the crisis was a big test for ESG strategies. I think there has been a lot of coverage about this topic. The evidence is telling us that ESG strategies have outperformed during the sell-off. I think that this is a very remarkable achievement because it will in some way remove that sort of mindset that moving to an ESG type of strategy will in some way reduce performance. So ESG strategies tend to perform well during market going up, but they also tend to perform well when markets go down or when volatility is very high. I would like to stress that because we believe very much in that trend. And I think we are going to see an acceleration on ESG strategy going forward, despite of the concern that the COVID might have raised.
Max, thanks very much. Before we move on to our second theme of commenting on the policymakers and their responses, I'd just like to come back to the question of swing pricing. And Christian, you wanted to make a few comments on that.
Yes, thank you very much, Robert. So I very much agree with what Massimiliano has said, that this has been a very challenging period in the sense that the sell-off has been extremely fast. So if we look at the European investment grade corporate market as an example, in 2008, spreads rose from 125 basis points to around 300 basis points. And this time around, spreads rose from 60 basis points to 200 basis points. So the magnitude of the spread widening has been comparable in both episodes. However, this time around, that market correction occurred in a period of less than 4 weeks, while in 2008, it took more than 6 months for the spread widening from trough to peak to occur. So it was much, much faster. I mean, it would say multitudes faster, 6 times faster than we had in 2008. And that certainly made it difficult for us to deal with the market conditions. Now, we've been able to do that without having to suspend, probably because we didn't have severe liquidity mismatches in our funds. And we've also been able to satisfy redemption requests without having large discounts to NAV. So as an example, and I think this doesn't apply to a lot of continental European funds, all of our retail funds still operate without swing pricing. So all of our clients have been able to redeem at any point in time at the NAV and to purchase at the NAV throughout the crisis for all of our retail funds. And I think this is not unique to Union Investment. This holds to a lot of continental European asset managers. Now, for the institutional funds that we have, we did establish swing pricing for the reasons that John has mentioned. I think it's a matter of fairness when you have very large in and outflows from individual clients. I would like to stress that the swing prices that we have established, according to the offering circulars of our funds, never exceed 2% of NAV. And we have a policy of not disclosing the actual swing prices that have been charged on a given day. They're determined by a sort of non-arbitrary process where we look at the size of the flows, yeah. But the formula will not be disclosed in order to avoid front running by individual clients. But in any case, it has never exceeded 2%, and I can assure you that it has been way below 2%. Now, when you purchase an ETF and you sell an ETF, during the crisis, you were facing situations where the discount to NAV at which that fund price traded in the market could be as big as 6.5%, even 8% for certain asset classes. And I'm not here to judge that. It's just an observation that when you buy a mutual fund, even the ones with swing prices, the discount to NAV has been a maximum of 2%. When you trade ETFs in the market, there have been discounts to NAV of as much as 6 or 7%. And it's, you know, people just need to be aware of that. It's not to say that one is better than the other. It's just a statement of fact.
Christian, thanks. I don't know, Joanna, do you want to respond to that at all?
Yes, I would. I don't think on swing pricing that there is anything that is continental Europe or any other type of manager. The swing pricing is there to protect the existing managers. I think it was used very selectively. So in our case, there were a very small number of funds that needed to have swing pricing. We will always try and make the swing pricing reflect the liquidity conditions in the marketplace. So in our case, we actually did increase the swing pricing factors, and our swing pricing factors were pretty similar to any the discounts on an ETF for like-to-like strategies. I think that's what you would almost expect. But I would say that there's nothing, the comparison in an ETF between its NAV and the price is almost a false comparison, because the NAV is backward looking, and it's got a number of bonds that will not have traded. And that's the same on a mutual fund as well. What the price of the ETF is showing is the actual price in the marketplace, often in the absence of activity in the underlying bonds. So if you think of a fixed income ETF, for example, some of ours were changing hands. When I said hundreds, some in America, it was like 70,000 times a day. In Europe, lower, but not far off. And you then look at the top components in the ETF and take the top 5, they may trade on average 30 times a day. So the ETF is actually providing insight into the real market conditions and is performing a price discovery function when the underlying markets are largely frozen. So I think I think the policymakers are seeing that as a very valuable function for the functioning of the marketplace.
Thanks, Joanna. Let's move on to the engagement of the asset management industry with policymakers. You know, our views on central banks. Secondly, our views on securities and market regulators, and then also, you know, the influence of fiscal policy and whether we think that fiscal action has been helpful or not. Let's just start off with central banks. And I guess by way of introduction to commenting on central banks is that when Lehman Brothers went bust, the Fed balance sheet was 800 billion. And in the financial crisis of 08-09, they expanded their balance sheet from 800 billion to about 4 trillion. At the beginning of this year, the Fed balance sheet was actually still 4 trillion. The last reporting week, it is now 7.2 trillion. So that's the extent of the Fed response. But Max, do you want to just sort of comment on your views on how central banks have navigated this crisis and your thoughts on whether it's been effective or not?
Yeah, absolutely. I mean, I think what we've seen as during the financial crisis, there has been an incredible activism by central banks. So what I would say that is different from the financial crisis is that this time around, we are seeing not only monetary policy playing a very big role, but also fiscal policy having a very important role. I remember very well our chairman, Axel Weber, saying, we cannot live in a world where central banking is the only game in town. Now we can really say that this is not the case anymore. Just to put things into perspective in terms of fiscal expansion, we are counting around 3.9% fiscal expansion as a share of global GDP. This is more than double what we had in 2008. So there is no doubt that monetary policy in some way is playing a very important role, but I think everything relating to monetary policy should be seen in conjunction to what's going on the fiscal side. So unprecedented monetary policy intervention, what did they achieve? First of all, they immediately prevented a health crisis transforming into a financial crisis. I think that was remarkable. Banks have been pretty resilient. I think this is also the result, of course, of the liquidity injection which has been introduced by central banks around the world. So we also mentioned already the impact that this had on liquidity condition in the markets, in the fixed income market. This also was very important to allow investors to adjust and trade during the periods of very high volatility. But there is something more here at play. You mentioned the size, of course, but I would also like to mention the fact that the broadening of the asset classes which can be included in QE, the most important one being credits, something very important. I know that there is a demand about that from our participants about fallen angels. The fact that the Fed has just communicated that they are going to do it, despite the fact they haven't done very much yet in reality, already makes you understand how important it is, the monetary policy in this regard. Now, what are going forward? I think there are some challenge, of course, ahead. I would say that the most important one is the one about independence of central banks, because of course, when you include the fiscal policy into the picture and the massive increase in debt that we are going to experience in the future, of course, there will be more pressure from Treasury on central banks to basically finance a deficit. That's something that I think will require a certain and good equilibrium, because as you know, a loss of independence of central banks might be a big issue also in terms of inflation expectation and of course in terms of stability in the financial market. On fiscal policy, very quickly, as I mentioned, very large, unprecedented, in an unprecedented way. But fundamental, we think, in order to provide support to the recovery, and of course to alleviate the impact on households and corporates during the lockdown. But that's also something very important that we are already started to see. Fiscal policy is in some way more difficult to implement than monetary policy. It is because of the political mechanism behind that. Now we are seeing some countries succeeding in sending funds to where they are mostly needed, but we are also seeing some countries failing or in some way not doing enough to support income and to support corporates. This for me has a very important implication also from an investment point of view. There will be winners and losers. And of course, this will become more visible as we move ahead into this crisis, when we will see how different countries are able to leverage their fiscal maneuver in order to support their economy on the way up once the recovery kicks in.
Max, thank you. Actually, while you mentioned you were talking about fiscal policy, and Christian, do you want to just add your, well, let's stick with fiscal policy for the moment. And, you know, do you want to comment on the effectiveness of the fiscal measures we've seen and, you know, where we go from here on fiscal policy? And obviously one key area is the EU recovery plan, which may or may not be voted on and decided in July.
Yes, thank you very much. So I would say the difference between, I would say there's a stark difference between the crisis in 2008 and the crisis that we're experiencing today. In 2008, we had a crisis which had its origins in the financial sector, and that started to affect the real economy. And therefore, the way to deal with the crisis was actually to look at the root of the crisis, which was the financial sector, and address it by basically, I mean, the main measure has been to recapitalize banks. And this time around, I would say the sequencing was the other way around. It was not Wall Street affecting Main Street, it was Main Street affecting Wall Street. So you had a crisis which had its origins in the real economy, a shock to revenues and earnings, and that crisis started to affect the financial sector. So therefore, the appropriate response was also not centered on the financial sector, but centered on the real economy. And this is where fiscal policy came into play. And I think it has played a decisive role and a very good role. And I'm also quite happy to see that measures and programs that have been successfully tested in the past in Europe, in continental Europe, are now being adapted in the UK and in the United States. I'm talking about the Paycheck Protection Plan. So basically keeping people in work, what we have in Germany is Kurzarbeit, that has now been implemented in the UK and in the US as well. And I think it's a very important measure in order to prevent hysteresis from the crisis and to keep people in work and also to prevent social stability, if you wish. So I think the fiscal response has been very strong and has played a very good role. And it has also been quite transparent. I mean, here in Germany, we're in the very lucky position that our deputy Minister of Finance is a former partner at Goldman Sachs, who actually used to cover me as a salesperson. And he's been very vocal and very, very sort of forthcoming in talking to people and being very fast in taking up initiatives and playing back and forth ideas with him. So that has been very good. I would also stress that the ECB has played an important role in stabilizing financial markets. And they're also, their way of speaking to the financial sector, I think, couldn't have been better. I mean, I'm a member of the ECB Bond Market Contact Group, and I can't even count the number of ad hoc conference calls that we've had over the last 2 months. I mean, it seems to have happened every other day or every 3-4 days. So very often we get calls from the ECB, what do you think, what's happening? And we've been able to provide feedbacks. And I think that has worked quite well. Now, going forward, I think that we were probably in for a period of longer period of very high deficits, just because I would say in that period from 2008 onwards, we spent a lot of time and effort in creating resilience within the financial sector. But I think we may not have spent enough time in building resilience in the real economy. Now, there has probably been an over-reliance on global value chain, and there have been very lean balance sheets by a lot of households and also corporates. So I think there will be a big strive to increase the resilience of the real economy, which will likely go hand in hand with an increase in savings rates, in precautionary savings rates of households, and also in a slower capex from the corporate sector. Now that increasing savings rates, I think there are basically two ways how this can play out. One would be that you have an increase in the financial balance of the private sector, households and corporate combined, and then we will all settle for a lower level of economic activity. And the other outcome would be that the public sector picks up that sort of excess savings and runs a bigger financial negative balance, a bigger deficit, a bigger financial deficit, in order to keep up aggregate demand and activity. And I think we're probably in for the latter. So that means that we were in for a long period of very high fiscal deficits in many countries of the world. And then the question is, how do we deal with that? And I think as long as you have a country that issues debt in its own currency and has full control over its own central bank, it's okay to increase the public sector debt. We've seen that in Japan, a country that has had current account deficit surpluses for a long time and happened to have a very high surplus on the side of the private sector and a high deficit on the public sector, and that worked quite well without creating any problems. In the euro area, it's a different setting because the individual member states haven't got control over the currency in which their debt is issued, and they haven't got control over the central bank either. So therefore, I think there is a need for greater amount of coordination and solidarity, and we're moving towards that with the European Recovery Fund, which I believe has been instrumental in stabilizing spreads in the market.
Yeah, I would agree with that. So we talked about central banks, we've talked about fiscal policy. Joanna, can you talk about how the regulators have responded to this crisis, and any areas where we would like as an industry improvements from the regulators in the near term?
Yes, thank you. So the securities regulators have reached out very proactively for market intelligence alongside the central banks like the ECB bond contact group. The Bank of England has got regular meetings with all different levels with asset managers with a common theme of trying to understand the pinch points and what would make the most difference. Linking back to the prior discussion on investment funds, I think one of the good factors was both the AMF and the CSSF increased the permitted swing factors. So the AMF would indicate that is impacting that French firms were also taking similar measures. The most important thing, I think, was that there was a general recognition that virtual teams at firms were under a lot of pressure to manage the crisis when people were working from home. So there was relief given generally in deadlines. I think that was the major thing that they did, whether it was reporting accounts or the introduction of new regulatory requirements or responses on consultations. However, I'd say that I agree with Max and Christian that the most important interventions were the monetary interventions and also the coordination that occurred between the fiscal and the monetary side. Looking forward, there's quite a large number of official sector reports considering what happened in market finance or non-bank intermediated finance. And they cover quite a lot of ground, whether it's open-ended funds, ETFs, money markets, credit downgrades, margin calls, operational risks. Some are even looking at commercial real estate, because if urbanization sort of reverses. So that's a huge palette. We would suggest that there are certain focus areas to look at. One, ensuring in each and every country that asset managers have the full liquidity risk management toolkit at their disposal. Secondly, one area that we would like much greater discussion about is the ecosystem at the front end of money markets. So banks don't have contractual obligation to make markets in bonds and money market instruments like CP, unlike revolving credit or ABCP. And we saw that the ECB introduced the purchase of bonds and non-financial CP in the PEP. So bond market is non-contractual, making markets is discretionary, but the PEP was very powerful in releasing that market. It that the ECB did not include financial CP, unlike the Fed. And that market is still stressed, particularly because, as in Europe, over 90% of the short end is bank intermediated. It's financial CP, not non-financial CP. So that is one area where we would try and urge greater discussion and an understanding of how that front end of the money markets works. A couple of other areas very quickly, introduction of a consolidated tape in Europe. It would provide a virtuous circle in terms of liquidity, and it would create a more level playing field between the retail investor and the sophisticated institutional investor. We'd urge for a classification system of exchange traded products. Not all ETFs are created similarly. We saw this with the VIX event last year. And in the COVID crisis, you saw some issues on commodity and levered ETPs. So we would really very much want a classification system so the end investor really knows the characteristics of what is an ETF and what is an ETP. One area that might be worth touching on, just because there's a lot about it in the papers that have been published, is about fallen angels. And of course, that is it has real economy implications. What the policymakers are musing about is whether there are cliff edge risks that exacerbate the pricing of those fallen angels, so the bid-ask spreads. And it's very clear that we have seen a sharp uptick in the crisis. And our analysis, we're coming out that it might get as high as, fallen angels might be as high as 35% at the end of this year, which is, however, below, it was over 50% in the financial crisis and over 45% in the Euro crisis, but it's still high. I think the key point we would say is that you don't see cliff edge results, because basically the downgrades are a process, not an event, and price adjustments start in advance of the downgrade itself. And secondly, most investors have both the motivation, because fallen angels perform very well, and also the ability, through deliberately building in flexibility, to hold downgraded companies in their investment vehicles. So separate accounts, totally. Mutual funds, certainly. You know, you might say a high grade fund has got to have 70 or 80% in high grade, and the balance can be in, say, high yield. Even index funds and ETFs have built in the flex, so you can hold a certain percentage of non-index securities for a certain amount of time, and until the manager finds that it's the right time from the perspective of the investors in the fund, to sell a security. So I think that's an area where we will see commentary, but the key thing is to educate, I think, on the flex that is built in by the private sector. The only case where we see that's not so is on insurance companies, where a lot of insurance companies have built into flex into their mandates since negative yields, you know, in the Euro crisis. They've deliberately done that, so they have the ability to hold high yield. But the incentives created by Solvency II, so if you have a long dated fixed income instrument that is downgraded, that can add considerably to the capital that they're required to hold on balance sheet. And therefore, it's almost like despite the flex that the private sector has built in, the incentives of the regulatory regime is counteracting that. And maybe that's something that should be looked at. I don't know, but I suspect that might be part of the CMU High Level Forum report.
Right, thank you, Joanna. Before we go on to sort of longer term themes post the pandemic, let's just use the next few minutes as an opportunity to address some of your questions. The first question, which actually I think is fascinating, is could you touch on what role electronic and algorithmic trading have played during the crisis? And this is an interesting debate as to whether electronic trading, algorithmic trading is a source of liquidity or a source of volatility? And I think it's actually quite difficult to come up with an answer to that, but I don't know which of you would like to try and answer that question. Christian,
well,
volunteers?
I can volunteer. I would say that you know, it proved not to be a stable source of liquidity, the electronic and algorithmic trading. You know, to be fair, our counterparties were also facing a difficult situation with a lot of them having to relocate to home offices. And I think those that supervise the trading activities, even of the machines, because often, you know, when the order goes into the machine and can't be filled, it is automatically routed to the actual physical trader. A lot of those physical traders had to relocate to their home offices, and I think there has been a psychological challenge for them in working from home. If you're on a trading floor and you always have that buzz around you, and then you're suddenly at home and you feel isolated, then your willingness to take on risk onto your book probably goes down, and that's what we've been witnessing. So we had two experiences. The first one was that initially a lot of the flow migrated from electronic trading venues and then from algorithmic trading back to the old-fashioned voice trading, and you know, basically trading with people instead of trading with machines. And the second experience that we had was that those people were much less willing to take on risks. I mean, to give an example of a conversation we've had with a trader on trading euro area investment grade corporate bonds, he said, well, you know, if I'm short that name, I'm going to give you a firm quote, a firm bid 2 price points below the screen. And if I'm not short, I'm going to give you a bid 6 price points below the screen. So liquidity in March has been terrible. It has been a real breakdown. There were days when euro area government bonds dropped by 20 price points. Talking about a long dated Hungary bond, 20 price points on a day. Yeah. So no doubt about it. It has been very bad. I think that that's also one of the takeaways from that crisis. We really have to rethink the infrastructure that has been put into place here in euro area corporate bond markets and government bond markets. And maybe just to add, I mean, this is all public information, which has been, if you look up the discussions in the ECB bond market contact group on the ECB website and the Q&As that the ECB has put out, there are discussions about disintermediation of investment banks in dealing euro area government bonds. I mean, we have a situation where the ECB has been going out into the market to purchase government bonds and corporate bonds all the time, yeah, and the banks have been unwilling to pass that liquidity on to end clients. So there is a discussion of disintermediating investment banks and having asset managers trade directly with the euro system, with the different national central banks of the euro area that carry out monetary policy operations on behalf of the ECB. So I think that's an open discussion we should have with the sell side after this crisis is over.
Yeah, I agree. There is one question which seems specifically for you, Joanna. Do you want to, one participant didn't quite understand your comment on the outlook for commercial real estate funds. Do you want to
so this is more recent, and in a couple of the more recent reports, some of them are asking about the future of commercial real estate. If firms generally, so not asset manager, not financial sector, but in general, if firms rethink their footprint and more people work from home. So that's something that's also surfacing in the official sector mind. I don't think there's anything in terms of what they think about it is a question mark at the moment.
And then just before we wrap up, just one final question on fallen, credit downgrades, and particularly how managers are handling fallen angels. And the one Moody's report, for example, that I saw recently forecasts, and obviously these forecasts come with a high degree of forecasting error, but one report is forecasting that by the first quarter of next year, default rates or restructurings or delinquencies in the global high yield bond market will approach 14%. And that contrasts with less than 3% if we look back at this February. So I don't know, Max, do you want to just comment on Do we have
Yeah,
a
we did.
here?
Yeah, I mean, Fallen Angels is about investment grade. Of course, corporates losing their credit status. I mean, we did quite a lot of work on this. We actually came up with some published estimates that are available on our website. We estimated that within the next 3 to 6 months on the US investment grade market, we are seeing around nearly 300 billion of downgrades. This is about more than 60 issuers. And actually in the Euro R investment grade, we're talking about 140 billion, 27 issuers. So we are in the area of a little more than $400 billion. First of all, here we went a little bit deeper, and that's, I think, very important for any investor looking at credits in particular, not only as a tactical opportunity because we still see value in credits, but also from a long-term diversification in terms of return enhancement, particularly given the level of yields in government bonds. So definitely there is a lot of attention on credits as a tool but of course there are also concern about the outlook in terms of default and fallen angels. Now here is a little bit, we need to be, there are different the sectoral differences are very large because there are sectors which are impacted directly from the COVID. Classical example is airlines or cruise companies. Of course, then there is the second order type of risk, which are the one where they will be impacted by the economic recession, which is a different story. Now, to make things short, in the interest of time, how is it possible that given the uncertainty about the potential default and investment downgrades, that you see more or less the whole industry is positive about credits as an asset class? I would say that's the consensus. I think it is because overall there is a conviction that first of all there is a massive policy support. We already touched upon the Fed buying credits. Of course, this is something which was missing in 2008, and in some way makes a big difference compared to the previous episode of downgrades, which, by the way, we had a lot, not only the 2008. I can remember very well the Euro crisis with the periphery, or I can remember 2014-15 with the oil market situation. The question here is more about the supply and the demand side. Probably on the supply side, we see still, basically there is a conviction that the market will be able to absorb these downgrades without any major disruption. And this is based on not only on what I mentioned, but also on the supply side balance. We see less supplies coming to the market. And the final point, we should not forget the search of yield. As a little anecdote, and I stop, I was very much involved in the Euro fiscal crisis about government bonds. As you remember, and as also Joanna pointed out, many investors are forced to drop the sub-investment grade bonds for their benchmark when, of course, there is a downgrade. If I look at ex post, and many investors actually did that on government bonds portfolio by simply taking out the periphery, the so famous pigs at the time. And in the end, if you look at afterwards, we have a situation where in reality it was not a very good move from an investment perspective, because not only the Euro did not break up, but actually, for instance, the BTP did relatively well and provided an additional return for many investors. We should not forget in Europe as well. Then there is the Europe-US. It's funny because we have a situation where we expect more downgrades in the US than in Europe, but we are a little bit more positive about the US than Europe simply because of the underlying size of the market overall. When we talk about 140 billion in Europe, this is a larger share of the corporate bond market in the US when you compare, Europe when you compare to the US. So overall, I would say the credits remain in a very attractive asset class, particularly if you believe in a scenario of recovery, which is the one I personally believe. But also we should not forget the more opportunistic type of strategy. We see a lot of interest about dislocation and strategies which tend to go like long short type of strategy on the credit markets as well, which is something that I think we will see more and more going forward.
Max, thank you. Let's just wrap up with 3 questions. First question for Christian. Is the major expansion in government and corporate debt that we have seen so far this year going to be a source of disruption to markets or volatility over the medium term? Are we as investors, should we expect higher volatility because of higher supply?
Well, thank you very much. I mean, that's really a crystal ball type of question, which is not totally easy to answer. Just to say, first on the government side, I mean, there are 4 factors that determine whether we will have a debt reversal, as they call it, or not. The first one is the level of real growth, it's inflation. It is the level of primary surpluses that governments are willing to run, and it's the level of interest rates that governments are charged in the market. So I personally don't see a high chance for a debt reversal through elevated levels of primary surpluses, because willingness of the population to pay taxes in order to pay back debt is quite limited at present. I don't see an increase in real growth rates either. If anything, they will go down. We're moving towards a period of greater onshoring and less division of labor on an international scheme, which will go hand in hand with lower levels of productivity, if anything. I really don't see much of an inflationary development either. So the only thing that can keep debt in check or actually bring it down will be low levels of interest rates. And that's what we're headed for. Therefore, I actually think that the level of volatility in rates markets, in core rates markets, will likely diminish and not increase. High levels of volatility will not be tolerated. At the US Monetary Policy Forum in February in New York, all participants from the Fed already spoke about yield curve control, and that was before the onset of the coronavirus crisis. Yeah, so we're probably in for some kind of yield curve control in all major economies, not just in Japan. And I think that we will see low levels of volatility, not just at the front end of government bond yield curves, but also at longer ends of the government bond yield curve, low levels of yield volatility and low levels of yield, because that is the only logical way of keeping government debt in check and bringing it down over time. A little bit, you know, if you look at the post-war experience in the United Kingdom had 250% debt to GDP in 1945 and brought it down to very low levels by having nominal trend growth in excess of its nominal interest rates. Now that will be the same. We will have the same going forward. The only difference being that the whole thing will occur at very low levels of inflation, and that implies that we will also have very low levels of nominal interest rates. So first answer, I don't foresee high levels of volatility in government bond markets, and I don't see high levels of yield in government bond markets either. Now that leaves us with the corporate sector, and there I would say that your question is much more difficult to answer. I think there will be bouts of volatility as we go through severe structural changes in our economy. It has been said before by Massimiliano, there will be winners and losers. Certain sectors that will find it easy to live in this new post-corona world, and other sectors that will struggle. I mean, Joanna spoke about the end of urbanization and what that could mean for commercial real estate. So there will be all sorts of structural changes in the economy, which will go hand in hand with elevated levels of volatility. And if you look at the performance of equity markets and of bond markets since the crisis, we can see that there have been huge shifts in sectoral performance patterns. You know? I mean, in the equity market, it's very obvious that we have a number of companies that have outperformed massively, while a large portion of the equity market has very much underperformed and is not coming back. And the same can be said when you look at the difference in performance between cyclical and non-cyclical sectors of the corporate bond market. So I personally think this is a great opportunity for active asset managers, which can look at those trends, try to identify them, and create alpha for their clients.
Thank you, Christian. Right, 2 quick final questions before we wrap up. Joanna, any structural changes that we should focus on in the asset management industry?
I think it's basically an acceleration of existing trends that we've seen already. So obviously the whole industry is going to suffer some degree of margin pressure, and probably the firms that saw greater margin growth following the global financial crisis will be better placed to withstand that. So I think you're going to see an acceleration of the trend towards, on the one hand, large diversified platforms, and on the other, boutique asset managers. Similarly, we're seeing in new client behaviors emerging and a big acceleration of trends that were already underway, whether it was sustainability or deglobalization in their thinking. So we're seeing a much more fundamental questioning of the underlying assumptions of their strategic asset management and their portfolio construction in the way that Max was talking about. So thinking about the new macro environment, uncertainty, and they're really questioning how can they rethink resilience in portfolios and be much more deliberate about it, and how the implementation in the portfolio construction can be much more flexible, as it were. I think the biggest thing, again, and this is again reinforcing something that Max said, is I think the most fundamental trend, I think, is going to be sustainability. Whether it was index or active, we saw flows coming in. We saw it across regions, in particular in the States. So that was the first time a fairly dramatic trend. And the key point, again, Max said this is already, the key trend, I think, is that it's no longer seen as a trade-off, but it's resilient in both good markets and in down markets. So I think that is going to be pretty fundamental shift in client thinking going forward.
Right, Max, final word to yourself. V-shaped recovery, U-shaped recovery, extended W.
Or Nike recovery, no? There was also the Nike one.
Yeah.
I mean, it is a little bit difficult to play the letter game, but let's start from the following. The markets believe in a V recovery. I think you still believe in it. The sort of big think tanks or a big international institution, they believe in a sort of a very slow recovery and eventually a sort of a subdued level of economic activity for a prolonged period of time. I got in when you have a situation like that, you normally have the massive dispersion in growth forecasts that I see. I am an economist by training. I never seen forecasts ranging from -15% to -5%. Normally, that tends to be a little bit narrower. So why is that? There is a massive uncertainty about the behavior of consumer and corporates in a situation which I think now we are starting to see. Economic activity in some way resuming, despite the fact that the coronavirus will not be gone, at least until we have a more radical medical discovery like a vaccination or something. I think in the end, what we are going to see, I'm personally more inclined towards a V recovery. Why? Because I believe that ultimately the corporates and individuals will adapt. Also, if the coronavirus is still around, of course, there will be sectors which will lag behind. Classical example is airline or even tourism. People will simply decide to go less around the world, probably for a prolonged period of time before we go back to normal. Now, this is very important because from an investment perspective, because the whole search for yield 2.0, the low yield environment, the support of policymakers will remain in place until we do not see any sign of a return to normality. Now, that's something that I think instead, if we're going to see a situation, a materialization of the V recovery with a big return, and there are some signs, given example, recent retail sales in the US showing that maybe consumption will pick up even a little bit stronger than what many people expect. This could have an impact, an implication for investors, because immediately the interest rate would react to that. And I believe in the current environment, the driver of investing and decision, not only about fixed income, but also about risky assets, including equity, it is the level of interest rate. It is not the earnings, which are driving in some way the behavior of investors with respect to these asset classes. So my person, probably the truth will be in the middle. But we are discussing internally different scenarios. There is no other way around. We attach a probability. We still attach the highest probability to a relatively slow recovery, which basically means that we will be back to, let's say, a sort of a normal level of economic activity in 2021. But we also have a scenario with still a low probability of an even stronger pickup, which of course will have repercussion on our view about different asset classes.
Max, thank you very much indeed. Well, I think we need to finish here. I would like to thank Christian, Joanna, and Max for participating in this panel. I hope we have added a lot of value to the thinking and analysis of those of you who've joined this panel. So thank you very much indeed. So everybody have a good day, and let's hope and assume that the shock that we had earlier this year to the global economy and global capital markets is largely behind us. Thank you.